So StashAway just did their third re-optimization to its portfolios since its launch in 2017. I think the StashAway team has done a decent job in explaining things. So I've actually attached a couple of links down in the description below. So if you really want to just read it in a bit more detail, I think it sufficiently explains what their thinking is all about. So why make this video then? You see, the key to success when it comes to being a financial YouTuber is to really talk about StashAway and other popular robo-advisors. Jokes aside though, I think the changes are fairly significant, and depending on your views as an investor, it could really matter. So in this video, I'm going to try and help you understand the approach, the key elements of the re-optimization, and the most important question, which is, so what for you as an investor? Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest, and feel better about money. The gist of the re-optimization is simple. It is that the economic environment has changed, which is why we are swapping out the different assets in the portfolio to take advantage of all these changes. Now, let me break down these two concepts, starting with what is this whole thing about the economic environment changing. The framework that they use is not uncommon in the investing space. So on the y-axis, you have economic growth. And as you can imagine, the bottom column would be low growth. And what happens there is, companies are not growing fast enough, maybe sales are not growing. And then, as a knockoff effect, imagine things like lower wages. Because things are not growing, they're not able to pay their employees more money. All these things are connected because where there's less spending, there's less profits. There's less profits, there's less growth. Positive economic growth is just the flip of that, where you are having sales and profits rising, hopefully wages are rising as well. The x-axis represents inflation, which is the rate of change of prices of things. In the box of low inflation, it really means that the changes of prices are going up, but at a pace that's slow enough for people to adapt. It's comfortable, and imagine that, hey, you and me, we're workers, we want to get our wages to rise as well, right? High inflation usually refers to an environment where prices are rising very quickly or rather unexpectedly. So this could be like, a shock in the supply system, or it could be just there's so much demand where prices are shooting up. And as you can imagine, if you are running a business and suddenly things overnight, the prices change and they went up so much higher in terms of your raw materials, this will create a shock and it's very difficult to adapt to. So with these four boxes combined, that's where it gives you kind of like a map of the economy. Low growth and low inflation gives us a recession, which is a term that you and I as common people, we would probably have heard of before. High growth and low inflation is what you would call good times, or in some other circles they call it the Goldilocks box, because hey, you want all this growth but you don't want prices to suddenly surge up, right? When prices and growth surge, that's where you have the other box, which is the inflationary growth box, or some people will call it reflation, because prices are going up but yet you're seeing comfortable pace of growth which is outpacing the inflation. The final box is the worst one we could be in, which is where you have low growth and high inflation. Again, it's not hard to imagine where if businesses and wages are not growing fast enough, but prices are just shooting up and not allowing businesses to adapt, then it can be very damaging. And that's where some people will call it stagnation or stagflation. And this is where you have the second concept coming in. And if you can imagine that four quadrants of economic boxes, think of them as like different environments or different climate conditions. Depending on the condition, different assets will perform differently. Think about it this way. If you were traveling, you want to pack the right kind of clothes and the right kind of gear for the environment that you're going to be going to. So just like the weather, different kind of economic climates will result in different assets performing differently. And if you're asking, hey, what are different assets? They are usually defined by maybe a category of sectors. For example, the energy sector, you could have the finance sector, or it could be defined as different type of asset classes. For example, real estate, maybe even commodities such as gold or even bonds. And here's where it gets tricky. This stuff is not science.
What?
So there are a lot of people who disagree on where we are in the economic quadrant. There are people who disagree with what type of assets do best depending on the conditions. That's why when it comes to investing, things are still so subjective. StashAway has its own secret sauce, and the really smart people over there have determined that we are in the inflationary growth environment. Again, higher growth, but higher inflation. And therefore, they have assets that they believe will do better, which is why they are changing your portfolio by swapping out the different assets. Speaking of secrets, it is no secret that channels like mine require some support from people like you, and hopefully you got value out of a video like this. If you did, help me click that like and sub button, maybe even drop me a comment below because it really helps my channel grow. Thanks. So what do the swapping out of assets do? From the previous portfolio, gold has already been there, but the allocation shrank to allow for different kind of inflationary protection assets. And that's where you have an increase in real estate, pretty high, it's about 20%. You've got energy as well, and then you have small cap stocks, and that's small cap US stocks, which would usually benefit from a growing economy. Because there's an increased demand and prices for raw materials, a country like Australia happens to do well, and that's a completely new inclusion into the portfolio. Consumer staples are there because they are just necessities, and when it comes to prices rising, they're resilient because consumers will still need to buy them because they're needs. And they also have increased their allocation towards Chinese internet stocks through that ETF KWEB. And it's because they feel that the long-term story of growth can be captured best using that particular ETF. More on that in a bit. Now, I'm going to stop here for a second and acknowledge something. I can understand where for many of us, we can be frustrated by a scenario like this. It's like you don't know anything about cars and you happen to own one and it broke down. You go to a mechanic. The mechanic is telling you, hey, there are all these different things that need to be done. And because you don't really understand cars very well, you understand the words that are coming out of his mouth, but it's very difficult to make a judgment of whether what he's saying is right or wrong. So for the rest of the video, I'm gonna try and answer the question of so what? At the end of the day, what does this really mean for me as an investor who might not really have the skill or the understanding to scrutinize what's being done to the portfolio? My first point is that if you are happy as a customer, you trust them and their analysis, and you don't either have the time or interest to try and look for the opposing view, you should really just do nothing. Sit back, relax, let this all play out. That's why you're hiring these guys, right? You're giving them money, you're paying them a bit of a management fee. They're there to take care of things, and you shouldn't worry your head about all these changes. Point 2 is that if you are new to investing, first of all, congratulations. Woo! If you can appreciate that basic 2 points which I talked about earlier, the economic environment shifting, different asset classes performing differently, you are actually miles ahead of an average investor that's able to appreciate a macroeconomic view. So this is an opportunity for those of you who are keen and curious to learn more about the different economic environments and then how different asset classes perform. Point number 3 is that if you happen to be squinting at the StashAway article and you're wondering if their analysis is right, rest assured that you are not alone. All I'll say is that their views about the current economic situation is not unique to them. There are many other different investors that share that same opinion. But at the same time, there are equally as many people who disagree. For example, one of those big camps are deflationists who really feel that, hey, because of falling interest rates, we are actually heading back towards an environment where very different kind of asset classes will perform better, and that's usually like growth stocks or tech-oriented stocks. My last point is that if you're sitting there feeling a little uncomfortable and wondering to yourself like, hey, Is this normal where robo-advisors swap out different assets and try and cater to the different economic environments? The answer is no. Not everybody does this. Before this reoptimization, StashAway's portfolio was defined as being all-weather, meaning that the assets chosen were designed to perform relatively well in nearly any conditions. Think of it as the middle ground out of the four boxes. Reoptimizing to fit an inflationary growth environment is a pretty bold move. It's like traveling to Europe in the end of summer thinking that, hey, it's enough time to capture the warmth, so I don't need to pack anything for cold weather at all. If the weather takes a turn for the worse, yeah, you might be caught with clothes that are just not suited towards colder weather. And similarly, the portfolio recommendation to build it and tilt it towards the inflationary growth environment, if they are getting it right, that's fantastic. If it's wrong, yes, the portfolio will likely not do very well. Just understand that timing the market is hard regardless of who you are and what your time frame is. And the case in point that I want to bring back up, remember I talked about Chinese tech earlier and that ETF KWEB, it got smacked really hard, and it's because recently there's been really a lot of clampdowns by Chinese regulators. I did a whole video about that. If you want, you can check that out. The point isn't about whether Chinese tech was the right call for them to make or not. It is that the entire approach of picking assets to fit the economic environment is StashAway's approach. Again, this is something you might not have consciously thought about, but if you are just now realizing it, you do have a choice. For example, besides StashAway, Saif's global RE portfolio works similarly. They look at the different economic environment, they cater the assets to fit that. When it comes to portfolios that are more fixed, Saif has its own core portfolios, and Endowus' entire approach is more fixed. So you do have options as an investor if you are not comfortable with the idea of market timing and you want something that's a little bit more stable. As a disclaimer, I'm currently still a customer. I've been using their 36% risk index portfolio since 2019. I'm fairly happy as a customer. I don't fully agree with the way they have been using or doing their asset allocations, but not to the point where I'm intending to pull any money out. I'm just gonna leave it there and see what happens. This was a challenging video to make, and I'm so sorry if this got a little too technical for you, or maybe I might not have gotten technical or detailed enough for some. So if you do have any other questions, hey, feel free to leave it in the comments below. I'll do my best to try and answer them. So that's it. Thanks for watching, guys. I really do appreciate all your support. So if you've got value out of this, hey, click that like, sub, and bell button, because I'm going to be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.